Welcome to World Ledger with Coco Key, your gateway to global perspectives on Bitcoin, blockchain, crypto digital assets, and AI. Everything here is for informational purposes only, not investment or financial advice. Views and opinions expressed by any speaker on the show are his or her personal ones.
It is so nice to have you do this podcast. I enjoy reading your post on Substack to explain the root cause of the Silicon Valley Bank's demise.
I think the real key to understanding what happened to Silicon Valley Bank is to know something about what we call the loan to deposit ratio. And that's really a key ratio. If you understand the loan to deposit ratio, I think everything else will make sense. So here's the way that works. A good bank normally takes in deposits from customers and then lends them out to other customers who need to borrow. And they, generally speaking, lend out 80 cents of every dollar in deposits. In other words, if they take in $100 from one customer or one group of customers, they'll lend out 80 cents to another group of customers. That means of all the deposits that they take in, they're lending out 80%. So we call that the loan to deposit ratio. And 80 is a good number. So why is that important? It's important because those depositors have a right to get their money back anytime they want it. So it's good to keep 20% of your deposits in the back drawer so that they're ready in case somebody comes into the bank and says, hey, I want my deposit back. So that is the key figure, 80%. Now, here's what happened. About 2019, Silicon Valley Bank had a very nice loan-to-deposit ratio. It was about 8%. They had $50 billion in deposits and were lending out $40 billion to other people. So they were lending out 80%. And if things had stayed that way, they would have been in good shape. But then we had the COVID. And as a result of the COVID, the central bank, meaning the Federal Reserve, began flooding the market with cash in order to buoy up the market, because the market started to go down, the economy started to go down, and we needed to kickstart things. And so fundamentally, the central bank, and actually this happened around the world, not just in the US, starts pumping money into the economy because Silicon Valley Bank had so many customers and such a high percentage of our target market. Our target market, as you know, was technology companies and venture capital firms. And technology companies and venture capital firms in general have a lot of cash anyway. And a lot of that cash that got pumped into the market found its way into the venture capital community and into the technology companies. And because we had about 60% of the whole technology/venture capital market, meaning 60% of all technology companies in the US, and 65 or 70% of all the venture capital firms banked with us. A lot of that excess cash came pouring into our bank. And suddenly our deposits exploded. They went from 50 billion up to over 200 billion in just 2 or so years. That's a huge jump. Now, you'd think maybe the loans would go up at the same rate, but they didn't. The loans went up some, but not that much. By the end of 2022, we had something like 60 or 70 billion in loans, but we had over 200 billion in deposits. Huge amount of deposits. Giant. And that is a big problem for a bank. And I'll tell you why. Number one, it's a huge opportunity cost because those deposits are just sitting there doing nothing. Now, picture that. Suddenly, at the end of 2022, we have about a little over 200 billion in deposits, only about 60 or 70 billion in loans. That means we have 130, 140 billion in deposits doing nothing, just sitting there. That's a big problem. And here's why it's a big problem. Number one is there's a capital cost because the regulations are such that increases the required amount of capital that the bank has to have to support those deposits. But that is a little bit of a complicated thing. Most people who don't understand banking regulation probably won't spend much time trying to understand that aspect of the problem. But the other aspect of the problem is very clear. Anybody can understand it. And that is a bank with too much in excess deposits. In any organization, there is one group of employees that's always the heroes. In a hospital, it's probably the doctors, maybe even the surgeons. In a technology company, it's probably the engineers are the heroes. But in a bank, it's the bankers, or we sometimes in our bank referred to them as lenders because that's mostly what they did was lend. So in a bank, the lenders are always the heroes. The CFO in every bank I know of, the CFO is jealous of the lenders because they would like to be the hero. Their view is, I'm just as smart as those lenders. I'm smarter than those lenders, and yet they get all the credit. Every time something goes well, they get the praise. What about me? I'm the CFO. I really deserve to be a hero. So they look at that 130 or $40 billion in excess deposits, and they say, I've got to do something with that to prove that I can make money for the bank too. And so what did they do in our case? They invested it. Now, there are different ways to invest excess deposits. One extreme, you could stick them into repos, repurchase agreements. Those are fundamentally Treasury certificates that they have a one-day maturity. They reprice every single day. There's no risk in a repo. Of course, you don't have a very high interest rate that you earn. So a CFO who really wants to show how important he or she is will take that money and put it into longer-term treasuries because longer-term treasuries have higher interest rates. They pay more. So there's a huge temptation for the CFO to look at all those excess deposits and say, I'm going to invest them in long-term treasury bonds. This is the other thing that people have to understand if they're going to understand what happened to SVB. If you buy a bond, it will have a rate attached to it. Let's say that rate is 5%. Now, suppose that something happens in the economy and rates go down. That bond ends up being worth more money than it was worth when you bought it, because it has a higher interest rate than the current prevailing interest rate. However, if rates go up, that bond will lose its value because the prevailing rates are higher and its rate is too low relative to the prevailing rates. That's actually what happened to Silicon Valley Bank. They sunk well over $100 billion into long-term treasury bonds. At the end of 2022, the Federal Reserve got nervous about inflation and decided that they would fight inflation. They started raising rates. And in the course of a 12-month period, they raised rates 500 basis points, 5 full percentage points. And that meant that those bonds lost a huge amount of value, almost $20 billion worth of value. But of course, that was only on paper. And if they'd been able to hold those bonds through to maturity, however long that was, it might have been 10 years, I'm not sure. some of it might have been 10 years, they wouldn't have recognized any losses because the bonds would have caught up with themselves. But in early 2023, they had to sell some of the bonds because they didn't have enough excess deposits that were free. In other words, that were still in liquid form to pay the depositors when they came in the door and said, hey, we'd like to have some of our deposits back. So they had to sell some of the bonds, and that may mean they had to recognize a loss on those bonds that they sold, which wasn't a very big number. The loss was less than $1 billion. And for Silicon Valley Bank, $1 billion isn't that big a deal. But because they started selling the bonds, they had to recognize the loss, and it caused the entire investment community to realize that if Silicon Valley Bank had to sell all the bonds, they would have had a gigantic loss, and it would have wiped out almost all of their equity. Well, they made that announcement on a Wednesday, and shareholders, as well as venture capitalists who were big depositors, did the math and figured out if Silicon Valley Bank had to sell all the bonds, not just the few that they were selling, it would be a disaster. It would be the end of the bank. And they created a run on the bank, which took less than 36 hours. And in less than 36 hours, they, in effect, destroyed the bank because they took out so much in deposits in that very short period of time, which wouldn't have been possible if it weren't for social media, because social media enables you to spread the word in nanoseconds. Without social media, it probably would have taken months, and then it might not have happened. But it did happen, and by Friday, the bank was a goner. It was 2 days later, the bank was a goner.
From March 8th till March 10th, just a couple of days, the bank was put under the receivership of the FDIC. Without social media and without the panic and the bank run, Silicon Valley Bank could still be around or may be able to sort things out by buying some time. Is that a reasonable assumption?
It is a reasonable assumption. If they could have bought time, in other words, if there were no social media, let me tell you, this is the second time that I have seen a bank run. Now, mind you, I wasn't at the bank anymore. I left the bank in 2019. So this was 4 years after I left the bank. I was not an insider. So I only learned these things myself over time by talking to people and reading newspaper articles. But it is the second time I've seen a bank run, because in 1990, 34 years ago, I was working at a bank called Bank of New England. And Bank of New England went down. It was bad real estate loans, and that was in Boston. The bank went down, but it took them 6 or 8 months to go down because they had bad real estate loans. People read it in the newspaper. Accountants and attorneys and investment bankers and other advisors to people started saying, you probably ought to take your money out of Bank of New England. And so people started taking their money out, but it took them 6 or 8 months. There wasn't social media. It was all word of mouth. This was totally different because with social media, you could get people to take their money out in literally 36 hours. That's the amazing part. So yes, if they'd been able to buy time, they would have been just fine. Because here's the important thing that I haven't mentioned yet, and that I really want to underscore. It was not the business model that killed the bank. It was the mistake on the part of the management team, in particular the CFO, of taking excess deposits and putting them into long-term bonds. When you do that, you're in effect gambling. At least that's what I believe. I believe that's like gambling because I don't think anybody knows which direction rates are going to go. You can guess, you can make an educated guess. In the end, nobody knows. I always say only God knows which direction rates are going to go. What banks normally do with deposits is lend the money, people who need to borrow. And that isn't gambling because that's something we analyze very carefully to make sure that we're lending money to people who can pay it back. Investing money in long-term bonds is a form of gambling, and that's not something banks should do.
Silicon Valley Bank, a mid-sized bank with over 40 years of history, should have some idea about the potential risk that the macroeconomics may impose on those bonds, or they are so used to the low interest environment for too long, they never imagine the macro environment would change. They would never imagine the Fed will raise interest and at such a speed.
You're making a good point. And that's exactly what happened because I talked to different members of the management team afterwards. And I said, why did you take all those excess deposits and put them into long-term bonds? I said, that's like gambling. And their answer to me was, rates had been very low for 20 years. We thought they would stay low. My answer to that was, hold it, just a minute. If rates are low for 20 years, I would think there's a good chance they'll go up. Where else are they going to go except up? But of course, that's only a guess on my part, too. Yeah, that's what they thought. That's exactly right, Coco. They thought rates have been low for 20 years. They're never going to go up. 2-3 things that I don't understand. One is, why didn't they hedge? Because they could have done that. And that would have prevented them from losing all that money. But they didn't hedge. That's number one. Number two is, I don't understand why the Federal Reserve regulators didn't stop them. Because Federal Reserve regulators know that it's dangerous to take excess deposits and put them into long-term bonds. And those regulators were living with the bank at that point. When a bank gets to be as big as SVB was, you don't have visits from regulators. You have regulators living in your building 365 days a year. They knew what they were doing, and the regulators didn't stop them. I don't understand at all because in my experience, when I was CEO of the bank, which was 2001 till 2010, regulators were constantly telling me if I was doing something wrong, and I didn't have any choice. I had to stop it. So I can't figure out why the regulators didn't stop it when they saw it happening before it got to be too big. It's certain they were there 365 days a year, and they knew that it was a bad idea, and they knew that they had the authority to stop it because Federal Reserve regulators in the U.S. have the authority to stop bad decisions from continuing in banks.
Here's my question, 2 questions. One is, what do you mean by the Federal Reserve officials living in your building?
That when you're a small bank, they come to your bank 4 times a year, or maybe if you're small enough, maybe only 2 times a year, and they spend 2 or 3 weeks and they go through everything. But when you get to be as big as Silicon Valley Bank had gotten to be, at the beginning of 2023, it was the 16th largest bank in the country out of about 5,000 banks. When you are the 16th largest bank in the country out of 5,000 banks, you've got regulators that have offices in your building. They're there every day. So they knew what they were doing all the time. But yeah, they were there all the time. But Coco, there are 3 things I don't understand. One of them, I already said they didn't hedge, and I don't know why, because you can buy hedging. The second thing is why the regulators didn't stop them. The third thing is every commercial bank has what they call lines of defense. That's not my term. That's actually what regulators call these things. A commercial bank the size of SVB had multiple lines of defense. Here's what they are. If the CFO makes a bad decision, you've got this executive team consisting of the CEO and other members should say to the CFO, that's a bad idea. If that doesn't work, you've got something called the Asset Liability Committee. And the Asset Liability Committee should step up and say, hey, that's a bad idea. And then you've got the Board of Directors. And the Board of Directors should step up and say, hey, that's a bad idea. And you've got the Chief Risk Officer. And the Chief Risk Officer should step up and say, hey, that's a bad idea. And then you've got the regulators themselves, which I've already mentioned. You also have the advisors. Goldman Sachs was advising SVB. Where was Goldman Sachs? Why didn't they say that's a bad idea? All of these lines of defense failed. And that I don't understand. I will say one thing, though. On the Board of Directors, which is one of the lines of defense, there was only one person with banking experience. And he didn't join the board until October of 2022, meaning that he had been there only 6 months when the bank imploded. So even if he had stepped in, he couldn't have stopped it at that point. It was too late. But that's odd to have a bank so big that it's the 16th largest in the country. And out of a board of directors, there are usually 10, 12 people on the board, only one person with banking experience. And worse yet, that he'd only been there for 6 months. So that's my third question. I don't understand how all these lines of defense failed. I want to say one more thing. There's one aspect of our business model that people sometimes focus on. And in a way, they're right. But I also want to tell you there's another side to the story. The one aspect of our business model that some people focus on would be we had a lot of depositors that had huge amounts of deposits in the bank. These would have been largely venture capital firms. And they may have, in many cases, a couple $100 million or maybe even more than that in our bank. And people say, well, that's the danger in your business model when you've got depositors that have that much money. It's uninsured, so they would be tempted to take it out if there was a problem. And then secondly, because the amounts are so large, if they took it out, it would make a dent in the deposit base. And I understand that. However, when I was CEO from 2001 until the end of 2010, what we usually did was this. If people came into the bank with giant amounts of money to deposit, we would encourage them not to put it in our bank, just part of it. So back in the day, if you came into our bank and you had $100 million and wanted to deposit it with us, we would say, no, that's not a good idea. Only put 20 million in our bank. Take the other 80 million and put them in a money market mutual fund account that's managed by somebody like Federated or Fidelity. Put the money there because you've got people who are professional managers of money market mutual fund accounts, and they will prevent you from experiencing losses. But don't put it all in our bank. Just put 20 million in our bank because that's what you may need for operating purposes in the next year or so. And I thought that that was a good solution. Of course, some customers were disappointed because they rather had do one-stop shopping, all in the same place. But this was a very, very minor inconvenience. If you have $100 million, it's not that big an inconvenience to only put 20 million with SVB and the other 80 million with Federated or somebody. That was a good idea because it helped us to keep our loan to deposit ratio in place, 80%. It made it unlikely that we'd ever have so much in excess deposits that the CFO would be tempted to do something with them that was going to earn a lot of money, lessened the probability that the large depositors were going to take their money out if they got scared. And even if they did, it wasn't that much money. It would have been a smaller amount, not a giant amount. And I don't know what happened to that practice, but it disappeared after I quit being CEO. I quit at the end of 2010. I moved to China and set up a joint venture bank with the Chinese Communist Party. They were one parent and SVB was the other parent. And so I was gone then. But when I talk to people later about what happened, I always ask, why didn't you still do what we used to do? That is, not let people put giant amounts of money into the bank. They said, well, because they were afraid they'd lose customers, because some customers got upset when they weren't allowed to put as much money as they felt like into our bank. My answer to that would be, yeah, I understand that. Maybe you lose a customer or two, but isn't it better to lose 2 or 3 customers than to lose the whole bank?
In your article, you mentioned your Harvard professor told you that if a bank grows more than 10% a year, it will die. So does he try to warn you that you have to have some discipline managing a commercial bank? If you let it grow and fly, like what happened to Silicon Valley Bank in the past 5 years, bad things will happen. So is that something relevant to what you try to practice with the bank when you were CEO?
Well, yes, I don't know if they still have a commercial banking class at Harvard Business School, but when I was there, we did have one. There was a gentleman named Charlie Williams, who was the professor of commercial banking. He was already old at the time, and I believe the semester I had him for the commercial banking course was his last semester at the Harvard Business School. I think he retired after that. He used to scare us all almost every time he spoke. Classes were an hour and a half. Sometime in that hour and a half, he would suddenly stop in the middle of whatever he was talking about and say, never let your bank grow more than 10% per year, because if you do, you're in trouble. You're taking on too much risk. Boy, did he make an impression on me. For years, I would periodically, not every night, obviously, at least once or twice a year, wake up in the middle of the night in a cold sweat, and I'd hear Charlie Williams. It always seemed like he was yelling at me. I bet you other students felt the same way. Never let your bank grow more than 10% per year. That really made an impression on me. And I do think that the growth was too rapid after I left. It was too rapid. And when it's too rapid, it means you've got to bring in a lot of new people. And you can only enculturate and train so many people a year. If you have 1,000 people, you can probably train and enculturate 100 new ones. But if you have 1,000 people, you can't train and enculturate 500 new ones. It's way too much. And that also causes the wheels to get loose and maybe fall off. That's the problem.
Yeah. I remember the book that you wrote, your first book, Culture Leads Strategy. You emphasized the importance of culture with the new big hiring. The management lost control of the team. Over 1,000 people were hired in that short period of time. It was difficult to imbue the new team with the culture of Silicon Valley Bank.
Yes, it's a very sad story because Silicon Valley Bank performed an important function in our economy, and it disappeared, put a hole actually in our capital markets. The hole is being filled, but it's difficult to fill the hole because all of our bankers, all of our lenders went to different institutions. Some went to JP Morgan, some went to HSBC, some went to Stifel Bank. Some of them, actually a large number, are with the new reincarnated SVB, which is part of First Citizens of North Carolina. And the problem is they're all competing against each other now, whereas before they were all together, one giant organization. They'll replicate over time what we had before, but it takes a while. And I also think the regulators are not as enthusiastic as you would like them to be because it makes them look like they failed. My opinion is that regulators don't want to create another one just like the old one, or let somebody create another one just like the old one.
So it's not optimistic there will be another Silicon Valley Bank type of bank to serve the venture-backed community, which is not encouraging for the innovation in this country.
I think that's exactly the issue. Now, I do want to say hats off to the Silicon Valley bankers that are out there doing their best right now, because I know there are thousands of people that used to be at our old SVB that are in different places right now, most of them actually at First Citizens from North Carolina, the new SVB. And they're trying very hard. They're doing their absolute best. But I think it's going to be tough to replicate, at least in the short run. Let's just hope they can replicate it in the longer term.
What happened to the joint venture in China between Pufa and SVB? Is it still around?
No. When the regulators seized all of SVB's assets in March of 2023, they disaggregated the bank, all of its different parts, and they put them all on the auction block. The bulk of it went to First Citizens immediately. Other parts stayed longer on the auction block. Ultimately, within a year or so, everything got bought by somebody, with one exception, and that is our 50% interest in the joint venture in China. Nobody ever bought that. And about 2-3 months ago, the Chinese government made the decision to dissolve it. In effect, it got merged into Shanghai Pudong Development Bank, which was our 50% joint venture partner. So it's gone.
Are you sad? Because you worked with the bank for 30 years. It's almost like your baby.
Yeah, it's very sad. Very sad. But that's another story.
That's a perfect segue to my next question. How about your new book, the book that you just published? Congratulations. Tell us a little bit about your book, what it is about, and what is the message that you want the readers to take from.
Well, thank you for that segue, and thank you for the question. I actually am going to have to tune out in another 2 minutes, but
Sure.
I'll tell you the book is, I just got a really nice review of the book in the Financial Times, a strong endorsement for my book. It's about the challenges that we faced building a joint venture bank in China. And of course, I wrote it, so you'd expect me to like it. But I think it reads quite well. And I think it provides a lot of insights into the challenges that Western companies face when they take their business to China. I would certainly recommend this book for anybody who's interested in what it's like to do business in China. It's a fascinating story, and it's available now on Amazon for only $21.
Excellent. Excellent. Quick question. Would you do a quick prediction of China-US relation with the new administration coming in next January? A quick one.
Well, I'm not very good at telling the future, but I am not optimistic. It's going to be difficult. I think having spent 25 years attempting to do business in China and 4 years living there, my experience is indicative. Working together with Chinese people is a very interesting experience. We just loved being in China. We really did. The Chinese Communist Party is a very difficult joint venture partner. That would be my one-line summary of my book, but I still would encourage people to read it because I think it's a good reading, provides a lot of insight. With that,
Thank you. Thank you, Ken.
Say goodbye, Coco. Thank you so much for this opportunity.
Thank you. Look forward to reading your book.
Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss out on my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.